Okay, everyone, we're going to make a start. So, we've had a really great turnout in terms of the number of people looking to attend. I think most people, though, are on a different time zone, so they're going to be watching the recording of this. But it's great to see you here, and I'm going to go through some of the key steps of investing internationally. And what we're going to do is we're going to cover some key things like a bit about us, why people invest internationally, misconceptions about investing internationally, and what options exist internationally. So, here is a little bit about us. So, we specialize in helping people all around the world. So, these are expat and high net wealth clients. And basically, our clients are in currently 109 different countries, all major regions. And most of our clients are future or current expats, people who have returned from overseas, or those looking just to diversify and invest internationally. And we do have inexperienced clients, but we also have those clients who already have an advisor, but they just want to diversify. Now, our team and entities have multiple areas of expertise. So we have, for example, a non-resident Indian division, we have British advisors, we have those who are focused on, for example, the North American clientele, and so on and so forth. Also product specialisms, and we've been featured regularly in the media over the years. Here's a selection of where our clients work, but not all clients work in big companies, right? Some are just like self-employed people. Some have worked at other companies. Now, this is potentially more important in terms of what do our clients and potential clients and others, what do they actually want to achieve? So retirement or preparing for a move is one thing. If someone knows they're going to move overseas, then ultimately it's good to prepare a few months or a year before. Asset portability for expats and high net wealth individuals. If you think about it, in most of our countries of residence or origin, many banks and financial institutions will close down your account if you move from that particular country. So a lot of our clients want to have access to different solutions. Hold on here, I'm just getting a notification. Okay. Sorry. So yeah, portability is very, very key in this situation. Okay, tax advantages if people move overseas. So obviously, if people are moving from jurisdiction to jurisdiction, they want certain tax advantages. Financial freedom by gaining income from a portfolio, planning for children's education if they're moving overseas, right? So if you're looking to send your kids to a country like, I know, the Eurozone or the UK or whatever, some people want to save and invest in that currency. Wealth protection and preservation, that's insurance, trusts, foundations. That is more like never being poor. That's not trying to expand your wealth, but that's just trying to preserve wealth and also make it easier if, God forbid, you were to die or get disabled to kind of pass assets to loved ones. Now, also, you've got security and stability compared to some countries. So obviously, if you're living in a developing country, you're not going to trust the banking system as much, maybe, as back home. Second residencies and passports. We've already mentioned a little bit about wealth structuring and foundations. Gaining more liquidity if you're cash rich or cash poor. So, for example, if somebody has a lot of assets, but maybe they don't have a lot of liquid assets. For example, let's say they have farms or land or property or companies, but they don't have a lot of liquid assets. There are certain liquidity solutions that can be offered to them. That can mean borrowing against their assets, or it could mean getting a loan against assets, or it could mean life insurance or whatever. Diversification of currency and other risks, that's a key thing for a lot of people. Also more confidentiality in certain cases. So we're going to go over that in more detail later in the presentation. Now let's talk about some misconceptions of international investing or offshore investing. Because most of us grew up in, say, the 80s, 90s, or 2000s, or before that, there is this perception still, much less than before, that offshore investing is like sleazy. So if you have a look at this image here, you've got the image from The Wolf of Wall Street of this lady who basically she actually strapped cash to herself and went to Switzerland to open an offshore account. Now, that was in the 80s, and obviously it's only a movie, but some things like that did go on. But these days, it means something very different, because actually most offshore jurisdictions now are actually more regulated in certain cases than onshore investing because of all the things that have happened in the past. So, for example, in your home country, sometimes you can get a bank account in hours, or you can just go to the bank 10 minutes later, 30 minutes later, you can get an account. Actually, many offshore solutions take longer because the regulation is actually heavier these days. And all it means is, if you invest internationally or offshore, it just means investing in a different country to your home country. So buying a property in Spain, if you're not Spanish, if you're a British person and you have a property in Spain, that's offshore investing or international investing. If you've got an account in the United States or the UK and you're not from those countries and you're not living in those countries, that's offshore investing. Another misconception is you don't have to be rich to undertake international investing or diversification. There are minimums, and we're going to talk about those minimums later on. But you don't have to be rich to invest. Also, tax reasons aren't the sole reason people invest internationally. Often it's portability. As we mentioned before, if you're moving around from country to country as an expat, you don't want your accounts closed every time you move. Planning for school fees and diversification of risk, having a plan B. Those are actually the main reasons. Tax is definitely one of the reasons, but that's usually when people are changing their residency. So, for example, if someone's leaving, I don't know, the UK or the US, they're going to live in Dubai or Singapore, and in addition to that, they want to invest internationally. That's more likely to be like a tax reason alongside other reasons. But increasingly, there's a lot of people who just want their assets in different buckets. And they want to invest internationally just to not put all their eggs in one basket. So speaking about not needing to be rich to invest internationally, minimums do depend on the advisor. The typical minimums are anything from $50,000 for a lump sum account to a few $100s a month for a monthly account. But of course, certain assets do have different minimums. And for us personally, minimums depend on who you're dealing with. So because of time constraints, my minimums are a bit higher than my team, but we try to be reasonable when it comes to our minimums. So it's a misconception that somebody needs to be super wealthy to invest internationally. Also, another misconception that some people might have, but this is more of a misconception for people who are coming from developed countries, is that offshore is less let's say, safe than back home. So I'd say most people who are coming from mid-income and developing countries or poorer countries as well, most of the world, they know very well that investing offshore is going to be safer than back home. But let's say someone's coming from the United States, the UK, some parts of the EU, or most parts of the EU, Canada, and so on. Some people might actually think that, well, it's great that it's portable, it's great there's diversification, but is it as safe? But in reality, the names you're speaking about are the same names you can get access to back home. So if you think about all the big financial institutions back home, whether that's in the UK, HSBC, Canada, RBC, the US, all these big names you can see on the screen, they're all available internationally. You can have a structure which is just as safe internationally as back home. So we've spoken about misconceptions about international investing. We've also spoken about, why people want to invest internationally. But let's talk about maybe why you should invest internationally or consider it. So the first thing is gaining access to assets you can't get available often in your home country or directly yourself. So let's say if you're living in your home country and you want access to sophisticated solutions like pre-IPOs, downside protection, so you protect if the market goes down. In many countries, you can't easily do that, or you need a significant amount of assets to do it. Whereas through an advisory company like ourselves, but many others as well, you can gain access to all of these sophisticated solutions. So, for example, if you're worried about the stock market, you're excited about the potential of AI, but you're worried about the stock market and you want to have some downside protection, you can do things like that more easily internationally through the right advisor. It's the wrong time to get a cough right in the middle of a presentation. But anyway, also, as per the last point, assets in the United States and globally, technology assets are becoming a bit stretched in terms of their valuations. So we're going to speak about that a bit later. But ultimately, it's always good to get diversification with your assets, but especially right now, because we are looking at a stock market which is highly dependent in the US and globally on a small number of AI and tech stocks. And there is big potential there, but there's also big risk, and we're going to talk about that, now. So if you look at this side of the screen, so there's forward PE ratio by country. It sounds very technical, but all that means is price to earnings is just a valuation metric showing how under or overvalued a company is. So basically, the lower the ratio, usually the better for an investor long term. The higher the ratio, the more you're paying. So if you have a look here, and this was in July of 2025. So actually valuations have gone up since this time. The US was at 22. Now that's pretty high, even compared to the US's historical standard. Yes, you could argue the US should have a higher price to earnings ratio than, say, Brazil or South Africa, because there's less risk in the US market. But it's very high. 22 is high compared to historical norms. And as per the right-hand screen, how it's actually gone up, it's gone up compared to a year ago. And by the way, it's gone up more since July because obviously stock markets have gone up a bit. Because if you think about the Trump tariffs that came in March or April, obviously there was a recovery, but by July, markets weren't as high as now. But if you have a look at this graph, you can see that many countries have very low valuations compared to the US. Brazil, South Africa, China, even the UK, Italy, Spain, Japan even, they're much lower than the US. And also, here's a key thing as well. The US market is very highly dependent on a small number of technology stocks. And that means that if AI does change the world in a fundamental way, the US could continue to outperform. But it's also risky to have your eggs in a basket that's dependent on like 10 or 20 stocks doing very well. And perhaps we should look at this also from a medium-term perspective. So since 2007, Chinese stocks have actually fallen during that time, whereas the S&P 500 has done about 500%, the Nasdaq over 1,100%. MSCI Africa emerging markets, they have gone up, but they haven't done that well. You might be surprised about that. You might think, well, there's been a lot of economic growth in those countries, like in Africa and China, but that's been the reality. Now, the dollar has strengthened, especially since 2011, despite the recent setbacks, but ultimately the dollar has got stronger overall against most of those currencies, and that's pushed down emerging markets relative to US markets, one of the factors alongside technology. However, some of these factors might go into reverse, right? I mean, the dollar had a weak period from 2000 until 2010. US stock markets had a weak period during the same period. So these things do go in cycles. So looking to diversify across different countries around the world can make a lot of sense because we've got a lot of mismatches now in terms of valuations. Now, this is quite interesting as well, because I mentioned about concentration risk. Now, if you look at this, even before the recent rises in NVIDIA and other companies, the US stock market was being heavily reliant on, or is relying a lot on these big tech companies. So from December 2022 to December 2023, excluding those big tech companies, the US market only went up by 6%. Overall, it went up by 19%, but that's because a small number of tech companies went up crazy, like 71%. And actually, since this has been made, it's only got more extreme because, of course, with NVIDIA and companies like that, it's only got much more extreme since this point. But this has been happening gradually now for 8, 9, 10 years. Big technology stocks dominating the US market. And this shows, again, this kind of big dependence on the US technology sector in the US market. So this particular graph is actually out of date already because now NVIDIA is not worth 4.5 trillion. NVIDIA is worth 5 trillion already. So you can see that this big reliance on big tech, it does mean that if those big tech firms fall in value, then people are just buying the US stock market and ETFs, and they don't diversify beyond that, could be in trouble. Now, having said that, you do need some allocation probably to technology, right? Because technology does change the world long term. We could be looking at a fourth industrial revolution. What's happening with AI and quantum computing is massive. But remember, the internet changed the world, but that didn't stop the dot-com crisis. So you do need some allocation, but you also need to be diversified across different markets. And you'll find that international stocks are less concentrated in the technology area compared to, say, the US in particular. So that's another reason why you should invest internationally. Valuations look better, but also from a risk point of view, you're not just dependent on a few big technology stocks doing well. Whereas with the US market now, next year, if NVIDIA and Amazon and the other big tech companies fall in value, it's going to be very hard for you to make money. Now, again, though, I'm not saying you shouldn't invest in the US market. The US market is a tried and tested market, very long term. I'm sure it will do well, but we are in a period where there's a lot more risk in the US market than before because of what I would call concentration risk. Now, a lot of people are asking, is this the same as 1999 or 2000 all over again? Because the IMF have called it a bubble or a potential bubble. The situation is different to 99 and 2000 because back then, a lot of companies didn't have real revenues or certainly not real profits, whereas now the big tech firms are making a lot of money. So, real revenues or profits are much better than 99. However, we still have to remember that compared to, say, 5 or especially 10 years ago, the risks are higher. There's no doubt about that because of this concentration risk that you should deal with partially by diversifying internationally. Now, there's another reason why people should look at investing offshore, and that's a plan B. So a plan B doesn't just mean investing. It could mean a second residency. It could mean bank accounts in different countries, but it can also mean having assets in different countries. It spreads your risk as well in terms of currencies. So this is a key point, right? So even though it's true to say a lot of the people who invest internationally are expats or future expats, a lot of people just want to put their assets in different countries to spread out their risk. Now, finally, another reason to consider international diversification is structures and confidentiality. This is partially a non-investing point, but it is linked to investing. Some people, they want enhanced confidentiality and asset protection. This could be for their companies, like trading companies, and it's structuring things in such a way. For example, if you're worried about, I don't know, litigation or a spouse or whatever it is, people have their different reasons, right? And we shouldn't judge them really in most cases why they want more confidentiality. But structures like foundations and trusts can offer that confidentiality to people. So whilst this is also about investing offshore or internationally, some structures can allow people more confidentiality over their assets. We're not going to speak about that too much during this particular presentation because we always work in tandem with tax, legal people, and structuring people for that. With something like this, you don't necessarily have to be super rich to do it. But what I would say is the difference between this and just pure international investing is if you're not willing to put at least probably 300,000 or 400,000 into a structure, maybe 500,000, probably it's not worth it because the fees are a bit higher to set up these confidential or more confidential structures. But certainly for people who are looking to achieve certain objectives, structuring can make a lot of sense. So, for example, if someone's quite wealthy and they're worried about their kids maybe overspending when they die, or for that matter, they're worried about the marriage partners of their kids. It might sound a little bit crude, but people do worry about things like that. Sometimes they'll set up structures where certain rules are put in place about when will the assets be given to kids and grandkids. Certain rules, what happens if I become disabled, incapacitated, all those kind of things. People tend to not want to think about these things, right, for obvious reasons, because you don't want to think about your own mortality or someone suing you or whatever. It's not a very nice thing to think about, but nevertheless, obviously, sometimes people should think about it. So in summary, international investing can be just as safe as back home. Often you're dealing with the same financial institutions as back home. And also the key reasons why people do it are plan Bs, diversification of risk, opportunities you can't get access to yourself or in your home country in some cases, good valuations compared to US markets at least. So those are the main reasons why actually people should do it, and certainly people should consider it. And actually taxation is only one reason. So for people who are already living in high tax countries and they don't plan to go offshore themselves, often it's not a reason at all. They understand that there aren't big tax benefits. If you're living in a high tax country, unless you structure your affairs right, often the tax benefits don't exist. So it's a huge misconception that most people invest overseas just for tax benefits. Actually, in certain countries, those tax benefits don't exist, but people just want to diversify their risk. If you want to reach out to me, this QR code should work. It should go to a meeting summary. So you can use that or go to my website, adamfire.com. As mentioned, we do have experts from around the world, different specialisms, and so on and so forth. Okay, the floor is yours. If you've got any questions, just type them in the box below. So I've had a question here. Is investing internationally any riskier than back home? So we did partially cover this earlier in the presentation. So what I would say is it depends what you're comparing it to. If you're comparing it to a developing country or any country that's had a significant banking problem in the last 20 or 30 years, then actually it's going to be much safer. If you're comparing it to a developed country, then you can get structures internationally which are just as safe as those developed countries. So that's a huge misconception that people have from a small number of countries like the UK or the US or whatever. Ultimately, if you can open up a good investment account in Luxembourg or now a solid financial center, it's going to be just as safe as in, say, the UK or the US. Okay, everyone. So I've got another question. Are bonds still considered a good way to diversify hedge against stocks? other options? Actually, it's a really good question because traditionally people would have this like 60-40 portfolio, right? They would have 60% in stocks, 40% in bonds. And when stocks fell, bonds usually went up in value. People would, see them as safe. Government bonds were a safe place to be. They went up in 2008 and so on. But the thing is now there's much more government debt. And we saw during the recent crisis with Russia and Ukraine in 2022 that actually long-term government bonds went down and they've never recovered, whereas stocks recovered quite quickly. So increasingly more people now are saying, well, okay, you can have some allocation to bonds, but maybe rather than say 60-40, have maybe 20% in bonds and 20% in alternative assets. Because, ultimately, short-term government bonds are still not that volatile. So short-term bonds can still have some kind of, part to play. But I think the longer-term bonds, they can still have good years, but I think they are seen as much more risky than before because there's a lot of government debt now. And what happened in 2022, when both stocks and bonds went down by 20%, has made more people question bonds in terms of, are they really worth it? Because traditionally you would say, well, bonds pay less than stocks, but because they tend to go up when stocks go down, you can then sell some of the bonds and buy stocks at cheaper prices. But to answer your question, I'm not saying bonds have no role to play in a portfolio, but I think people should think about it more carefully. Maybe some corporate bonds, for example, as an example, individual corporate bonds, but also alternative assets as well, good quality alternative assets. If you're just looking to hedge, that can also make a lot of sense. Can you help set up a religious trust in the United States? And if so, can I own real estate in the EU that is owned by the trust? So when it comes to a religious trust, we have not actually done that before, but we do have experts on hand who can advise on that. What I can say though is if you're kind of open about the structure, yes, you can own real estate in the EU owned by a US LLC, but also a big thing I would say is I would be open about the structure in terms of, obviously you've got my details, I presume anyway, from signing up to the webinar. So a US LLC, depending on where you're based and so on, might be the best option for you, but also speak to an expert and we can help you with that in terms of deciding, is another structure better? But yeah, I'll get back to you though on the religious trust, spendthrift trust, as you say. If you give me your contact details, I think I might have your contact details anyway, but if you just give me those contact details after the call, I'll follow up on that. Okay, everyone. So quite a few interesting questions there. So I think we're pretty much out of time. So thanks a lot for your time. Obviously, this was designed as an introductory kind of webinar. If you have any questions, you can always get in touch with me also after the call. I'm glad my voice just about made it until the end of the presentation. I wasn't expecting to suddenly start coughing, but thank you very much, for your time and see you again soon.